For the first time ever, I'm going to talk about WR Berkley stock, ticker symbol WRB, an insurance company specializing in commercial lines property and casualty insurance. And this stock is on fire, up 26% year to date. Not too long ago, they presented quarterly earnings with a beat on EPS but a miss on revenue. They also pay an awesome dividend of 1.5% and having great growth stats at only 8% payout ratio. So why is everyone sleeping on this stock? Let's find out. Diving into the earnings release, we see that revenue is up about 10% year over year, so we're off to a great start. However, net income and EPS are both down year over year, and that's due to higher expenses. Premium written is also up year over year, but unfortunately the return on equity is down slightly. It has to be said that 19% is still a great number, especially if we take a look at the historical chart, where most of the time they were hovering around 15%, and the trend line is going up. So I think we're good here, especially if we take into account that 15% is the industrial average. It's the same with the premium written and net income. It feels like 2024 was a little bit of a fluke. And WR Berkley is comprised of individual operating units, with each and one of them have a specialized knowledge, making it a successful business as a whole. Taking a look at their debt, we see that debt to capital ratio is at 25%, which is improving year over year, so this looks pretty good to me. And WRB loves to create value for the investors, through dividends and share buybacks, a great combination in my opinion, especially since they pay regular dividends and special dividends, compounding at 11% annually. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. WRB Stock is a 29 billion market cap company. PE ratio is at 17, which indicates they could be undervalued right now. Later in this video, I will show you my 3 price targets for WRB stock, so make sure to watch until the end. Revenue is at 14 billion, and in this graph we see that revenue went up at a steady and consistent pace. Ever since 2020, revenue accelerated a lot. Margins are going up and down a lot, which is something that happens more often to these type of companies. However, the fact that gross margin is having a trend line downwards is something that concerns me a bit. On the other hand, net margins has a trend line upwards, so that's the silver lining here. The EPS is going up as well, and again, it's a similar pattern as the revenue. To me, this looks pretty good. Analysts have mixed feelings about the coming years for the EPS. It is expected to see a 8 to 10% increase annually in the coming 3 years. However, in 2028 it is expected to see a big decline, which feels a little bit random to me, so let's take this with a grain of salt. For the revenue, it is kinda the same story. Decent growth numbers in the coming years, and all of a sudden it's expected to see a 20% drop in revenue. Return on assets is sitting at 4.3%, which is a decent number. But the most important number here, return on equity, is reported at 19.4%, which is a great number. And earlier in the video we saw that it is increasing historically, so this looks really good to me. Current ratio is at 0.32, which is a great number. Nothing really special to mention here, to be honest. And right now WRB has 3 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. WRB has 2.5 billion in total cash, so they can pay down almost all of their debt at once, which is really great. However, it is still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is looking pretty good. It's not always steady and consistent, but of course, this is highly impacted by several events within these type of companies. Shares outstanding are decreasing, which is something that I really like. I think this one is one of the things that people most overlook. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 1.5%, which is a decent number for this type of company. Annual payout is $1.07, and payout ratio is at only 8%, and they have been growing that dividend at a pretty high number for 19 years in a row, which is really impressive. Looking at the historical dividends, we get a little bit of a diluted graph, with stock splits, special dividends and their regular dividends. Down the line it's going up, and those special dividends are a bonus, so keep that in mind. In this graph we see the expected dividends in 2025, 2026 and 2027. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to see an increase from here, but somehow it is expected that in 2026 we see a decrease, which to me feels a little bit random. Overall these dividends look really interesting to me. And now I want to add something new to my video. Let's ask ChatGPT to come up with some bear cases for the company. And they come up with 4 arguments why we shouldn't invest in the company. So let's see if we can tackle them. So for starters, ChatGPT says that WRB missed on earnings most recently, which is completely true. However, a single quarter earnings miss, especially by only a small margin, is not very uncommon in this insurance sector. And let's not forget, net premiums written increased 10% year over year, showing healthy underlying growth. So, number 2, declining return on equity year over year. Well, for starters, 19.9% is well above the industry average, which often hovers about 10 to 15%. Also the historical average for this company. So they are actually still doing really good, and I expect the return on equity to hover around this number, since 2024 was a fluke with nearly 24%. Number 3, exposure to catastrophic losses, where in the recent quarter there was a combined ratio of 91%. To counter this argument, well, this is part of the insurance business of course. WRB has a long record of prudent underwriting and strong risk diversification, and their combined ratio remains below 91%, which indicates they are still running a profitable insurance operation, even after significant losses. This suggests resilience, not fragility. Number 4. The stock is trading near its 52-week high. And this is an interesting one, since why shouldn't you buy an undervalued company that is trading at its 52-week peak? Successful businesses often trade at premiums, but compared to its peers, the PE ratio is pretty reasonable, so momentum is actually with the company. Now that we have come up with some counter arguments, it's you that needs to have an opinion about these things. I'm here just giving reasons why we shouldn't invest in the company and try to see things from another perspective. Let's move on to the returns in the past 5 years. I decided to compare WRB stock with the overall market, in this case the S&P 500. On the 5-year chart we see that WRB massively outperformed the S&P 500 with a total 250% return, including dividends. Meanwhile, the S&P 500 is sitting at 118%. And on the 1-year chart it's the same story, with WRB sitting at 43% return, while the S&P 500 is sitting at 14%. So WRB is almost tripling the S&P 500 returns. On the 6-month chart it is an even bigger difference, with WRB is sitting at 22%, while the S&P 500 is sitting at a shy 2%. On the 1-month chart, we see that the S&P 500 is finally winning, with 13% versus 7% for WRB. So bottom line, in the past 5 years, WRB was by far the better choice here. And most recently, the S&P 500 starts to outperform the company. So could this be the perfect time to buy WRB stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in 7, 9 and 11%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm putting in 12, 13 and 14. For the free cash flow margin, I'm putting in 23, 25 and 27. For the PE ratio, I'm putting in 14, 16 and 18. For the price to free cash flow, I'm putting in much lower numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. And right now WRB stock is around $73. I hit analyze and we see a lot of green numbers. We have a low price target of $65 to $85, with a mid price target of $88 to $118, and we have a high price target of $118 to $162. To me, the mid price target is the most justified here, indicating that this stock is massively undervalued based on these numbers. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on this company is that I'm really impressed by the fundamentals and the historical performance. It's a great company that is well structured with numbers that outperform the industry. On top of that, they buy back a lot of shares and pay decent dividends, which lead to increasing value for the stockholders. On top of that, they are undervalued in my opinion, which is also the reason why I'm going to buy this stock in the upcoming days, when the market opens. And I can't wait to have this stock in my portfolio. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.